Sure.
I was just going to say that.
Finance when they don't know finance.
It's true.
You know?
True,
That's where
there's a
the
big-
tough part comes in.
Yeah, there's a big disconnection. Then also, I think in the past couple of years, let's say I got to move this closer because I feel. There you go.
Yeah.
More echo.
Oh, yeah.
I feel like parents maybe had there was a demand factor for a good amount of time. I think in George Bush's
damn,
era.
You look good. Make me want to start dressing up again. I stopped dressing up, man.
And I'm in t-shirt every day, dude. I wore this because I knew I was coming to see you,
You
bro.
look fantastic.
Appreciate that.
You got that light pinks, call it salmon.
Salmon.
Yeah. I love it. Let's see. I've got ChatGPT ready to go if we need it. Let me get rid of that. That's good. That's good. Does
Click
your
on the
company have a
reference.
website?
Yeah, company website is portfoliocapital.com.
Got it?
Yeah, we're up.
And welcome back to another episode of Key Factors Podcast, Real Estate AF, where the AF stands for And Finance. And I'm your host, Mark Jones, and we are powered by ReviewMyMortgage.com, the largest index of mortgage programs in the nation. And today's topic has a lot to do with finance, guys. I want to continue to bring you all new experts in different fields of not just real estate, but also investments and financial world. So I'm going to read this real quick for you because this is about the firm Portafolio Capital Management. Portafolio Capital Management is an independent wealth and capital management firm based in San Antonio, Texas, with over 12 years of combined investment and macroeconomic analysis experience. Our goal is to instill confidence in investing through how we view markets and our investment approach. As a registered investment advisor, RIA, and fiduciary, we are held to the highest standard when it comes to managing your money and are bound by law to act solely in the best interest of our clients. So without further ado, I'd like to introduce my guest today, Mauricio Sanchez. How are you, sir?
It's good, Mark. I'm doing well, man. How are you?
I'm doing well, man. It's been a minute.
It's been a minute, man. Thanks for having me. Thanks for inviting me on.
Yes. So those of you that are tuning in as of right now, a little background. I started working with Mauricio Sanchez at Woodforest National Bank inside the Walmarts. We were both the most good-looking, best-smelling cats you could ever find. But we are also slinging banking products before we even really knew what it was to be banking. But now that we're in our big boy skin, Mauricio, if you could tell us a little bit about yourself. Where'd you grow up? Where'd you come from? All that good stuff.
Yeah, so I'm San Antonio native. Parents moved here when I was probably about a month old.
Okay.
I grew up in Alma Heights until 98. If you're from the city, you would understand the flood of 98 washed a lot of people out of the area. So my family being one, we moved to the north side, went to Clark, graduated from Clark High School, and eventually moved back, went to UIW, got my bachelor's in economics there, and spent a little bit of time in New York, a little bit of time in Austin, came back to town, and now this is forever home. San Antonio's always been home, but we're back. I'm back.
Where you hang your hat.
Where I hang my hat, man.
I love it. So that being the case, let's dive into how you got into the field that you're in today. Because it's been a while. This is basically catching up with you.
Yeah, man. It's been years for sure. So I originally started as a fashion major.
Yeah.
So I started at UIW. I heard UIW had a great program in fashion merchandising. My idea was, hey, get my degree here and try to get into, I don't know if you've heard of brand Diesel, but Renzo Russo was actually running the brand back then. A lot different from what it is today. I wouldn't want to work at Diesel today, but back then, Italian founder, big part of the brand. He was actually designing everything, and I was like, man, it'd be great to get a position here. Mm-hmm. So one semester in, I took a finance course because it's part of the curriculum that you take at UIW, and I said, man, this stuff is really like, this is where I kind of want to take my field to. So I ended up leaving fashion merchandising, and I went into their school of business. And I changed my major to economics and finance. They had a dual major then. And I did that during my studies there. I had a professor that had a profound experience, that had a profound movement in what I was learning. And I began to trade Forex during my sophomore to senior year
Would you mind,
Yeah.
and I don't want to break up your story,
No,
but
yeah.
explain to our listeners what Forex is, because there's a lot of folks that
Yeah.
understand it. There's a lot of people that hear the word, throw it around, and just have no clue.
Yeah. So Forex today, I mean, if you were to Google Forex today, it'd be a lot different from what it was then.
Yeah.
Forex today, a lot of people are just following trade pattern signals, and then they're taking positions. But basically, the industry of Forex is foreign exchange currency. So what it is Forex is the short term for foreign exchange.
Okay.
Basically, it's brokerages that are pairing different currencies from different parts of the world. And then from that, you are able to take a position. So you're ideally betting on the appreciation or the depreciation of a currency based on, economic factors, typically economic policy, so monetary policy
monetary
specifically.
policies, what happens in the
Right,
news
right.
in many cases.
Yeah, what happens in the Fed.
That's
so
right.
a lot of what I was doing when in that Forex movement was really paying attention to what the Federal Reserve was doing here, the European Central Bank, the Bank of China, the Bank of England. So you have all of these banks that establish monetary policy across the world.
Yeah.
And every time that happens, you see currency pairs go haywire, volatility builds up, and that gives an opportunity for Forex traders to make money.
Basically speculation on that
That's
market.
exactly what it is. That's exactly what it is, man. But that's Forex in short.
Wow. Okay. Back to yours, because you brought up another something that I want to kind of pry onto, but not yet. Please continue down your journey.
Yeah. So profound experience with a professor. Started trading Forex between my sophomore and senior year. Years into it, I said, hey, it would be awesome to actually manage money, work for a firm, and then try to build my name in what I'm doing. And I ended up working in private wealth. It wasn't, we weren't making a market with the public, but it was more of a private office in Bernie. I was there for about 3 years, 2 years.
What was the office?
They're private. I would disclose the name, but everyone would probably know.
Yep.
And then I wouldn't want to put that position out there. But but long story short, I was there for a couple of years, and I caught wind of a couple of different firms hiring in New York. So my ultimate dream throughout this whole journey was to actually be in New York and participate in finance at least for a year.
How cool.
And to see how it was.
Yeah,
And,
I remember visiting New York many times in the past and walking down Wall Street and just seeing all the action and people moving, and then all of a sudden lunch is done and there's nobody on the streets. Where are they? They're back in their dugout.
Yeah, man.
Trading.
Energy there is nuts. There, so specifically downtown, I worked in Midtown. Midtown is more of the hedge fund world.
Yeah.
Downtown is where you see all the brokerages, the market makers. But we were in an office with a couple of other hedge funds in Midtown off of 55th and 6th.
Okay.
If you've gone recently, you've probably seen the Love statue.
Yeah.
So the Love statue downtown used to be, I mean, not downtown. Midtown used to be a 55th and 6th. We work at the building right next to it.
Oh, wow.
Yeah.
Okay. Wow, man. Yeah. New York is a magical place. I will say that I am one that does like going to New York in small doses.
Same, man.
There's no way I could live there. It's just too much walking, too many people, too much garbage on the streets, et cetera, et cetera. It smells.
It smells, man.
Yeah,
it smells. That's probably I didn't live in the city specifically for that reason.
Right.
It was like there's too much people walking around that I don't want to interact with, and then two, it smells like it just smells.
It does, yeah.
And being in Brooklyn was just good.
It kind of puts things in perspective. Us being in Texas now, everything's spread out. We've got garbage men that come across every so often, et cetera. Whereas New York, they throw everything onto the streets, and then the garbage man comes around like once a week and picks up all their shit.
Yep, and you smell it, man. You're walking anywhere, and you see piles. What is it like? Probably like a good ton of garbage that's sitting on the corner right next to your apartment.
Nuts. Yes, it's a little bit better if you go during the winter because the stench is not as pungent, so to speak.
Truth.
So when you were in this transition, kind of soul searching, but still knew what your end goal wanted to be, were you making any money at that time? I mean, what was that like?
At first, you don't. At first, you're a coffee fetch man, and this is kind of what's established my foundation on how I do my mentoring. But ideally, you're fetching coffee. You're making $300 a week.
Yeah, I believe it.
And basically, if you don't want it, tell you, well, cool, get the fuck out the door.
Right.
And that really establishes the precedent of what you're getting into.
Right.
And it's really more of a respect thing than anything, because you're making crap money.
Yeah.
And there's no question about it. There's no way of living in New York if you're making crap money. But the idea is get your license, get on the phone and begin to sell, make a market.
Sure.
We were doing high yield bonds back then.
Gotcha.
So we're selling Logan's Roadhouse. There was a company called Dex Media, a few others. But we were basically pitching. We were pitching stock and we were pitching bonds. My team was ideally focused on pitching bonds. But yeah, to answer your question, you're making minimum money until you get licensed. Really how it works is you're a coffee fetcher, the leader of the company, which is we're in an office. If I could put this into perspective, this is the Wolf of Wall Street.
Yeah.
You're in an office with 100 guys.
I was just gonna say it's like Wolf of Wall Street,
It's
boiler
100%
room.
boiler room.
Wow.
Yeah, there's a story that goes behind that, and we'll talk about that later. But basically, you're going into an office with 100 guys. There's 6 girls that are each of the admins for the senior brokers.
Gotcha.
So you go in there as a coffee fetcher, as a lunch fetcher, and ideally one of the 6 either like you or don't like you, and they what they say is like they adopt you.
Sure.
So I was adopted. Fortunately, I think probably about a month into my thing. Some people don't get adopted until
that's
like 3
pretty
months,
quick.
man. Yeah, and basically when you get adopted, it's basically
It was your good looks and the great smell.
maybe the great smell, man. It was funny, man, because I would walk into like we'd leave the office or we'd get into the
Smells
office.
really good. He really
Smells
does.
great in our booth right now.
Smells really good.
We'd get into the office, man, and I would run into this guy. I didn't know who he was, but he would give me a hard ass look every day. I'd run into him in the elevator, and then leaving the office, I would run into the elevator again, and he'd just look at me and he'd be like, and I'd be like, "What the fuck am I doing? Like, what am I doing something wrong?" So like a couple of weeks go by, like I said, a month later, I get called down to his office, and he's like, "Hey, you're joining my team. You're not listening to anyone. I'm paying for your licenses," which is like the big woo, right? Because you're like, now I'm not going to make shit money.
Yeah.
But yeah, long story short, or you hope, right? Yeah, but long story short, you make crap money until probably with me, I think it took me 45 days to actually get my license.
The reason why I asked that, to put it in perspective for the listeners, is there's a lot of realtors and lenders that watch and listen to this podcast.
Yep.
And a lot of the experts that I have on here continually bring up the concept of, when you're new to the business, you almost have to have the passion for working for free or very little so that you can learn as much as you possibly can. Thinking that you're going to get your license and all of a sudden be a runner and a gunner. Does it happen? Sure. Especially with social media. But then when you run out all your gas, you forget how to do the basics, how to do this, how to talk to people, how to sell basically. And in your line of work, that spectrum, it's almost the same, but it's encouraged to have that in place. Not necessarily a hazing period, but hey, man, you got to earn your stripes.
Oh yeah,
It almost drives us insane to where a brand new to the business realtor or lender is all of a sudden seen as equal to somebody that's been doing it for years, and that's just not the case.
Right. So you're saying in your industry, people that get licensed and they go in, they're already on the level of everyone else. Yeah.
In perception wise.
Okay.
We know that they don't have the layers of ass whoopings that we've taken, all the tragedies and landmines that we've stepped on throughout our career thus far. But putting a social media post out saying that I'm now a realtor is going to get you business in some way, shape, or form over an experienced lender that can actually advise you, understands the different programs, the ins and outs, can see into the future of, I'm looking at a credit report, that's going to be an issue. Let me raise that question now. Whereas newer to the business, they're not even going to know. It's going to go through their operations team is going to be the one that goes, hey, did you see this?
Right.
Type concept.
Right. Yeah. And I mean, I think it's important to have someone that's experienced. I mean, specifically in my world too, I'll give you an example, but like in my world, yes, you're 100% correct. I think that it's important to hire someone with experience, but that's not the only factor. You got to hire someone that's really open to the dynamic, because our industries change, and they change on the daily.
That's the only thing that's constant.
Right. And somebody who doesn't. So, for instance, I was in the panel speaking in Austin about a month ago.
Okay,
and I'm in the panel and I'm with guys that are double my age. And they're talking about right now, okay, interest rates, the conversation of then was interest rates are coming down, emerging markets look attractive again. And I'm sitting there like, emerging markets look attractive again. Look at all the geopolitical tension that is happening across the world. And maybe they didn't come from a world where they experienced much of that during their career, because we've been in a bull market for 16 years, and ideally that's like all they see, that is it's been money.
Right.
But people like myself that have been like barely making a market in this,
Correct.
I pay attention to everything. I'm paying attention to economic policy. I'm taking into account geopolitical risk. And Jamie Dimon speaks about this a lot.
sure.
But
Yeah.
one of the biggest factors in geopolitical risk is that emerging markets are depressed based on what's happening. And so you have on this panel, I'm sitting with probably like 4 other older guys, and I'm like, do you not see this? And sure enough, so I brought it to point. Sure enough, after the conversation, I had like 10 people come in, and they're like, I've never thought about these things, but you are so right. It's very important to consider that. And I'm like, absolutely.
Yeah.
So long story short, yeah, that's kind of how I see it.
Well, I mean, it's one of those things that perspective is only yours,
Right.
until you gain outside perspective that allows you to increase that broad, narrow-minded view that you currently have.
Right.
And I believe in order to be a great investment banker and a great leader, a great manager,
Yeah.
especially when it comes to people's capital,
Yeah,
you've got to be able to see it all
for sure.
and know how these strings will affect this over here.
Right.
I can imagine that's pretty that's a lot of stress, maybe.
I mean, it's stress, but it's also, to me, it's opportunity. Like
Yeah.
that stress to me is like, hey, it's great that, yeah, I'm going through the learning. And ideally, when you think about it, like we're walking I don't know if your parents are still around, but I'm walking to my I'm walking my parents on how to use ChatGPT. And I would assume that I meet a lot of other money managers that are the same age as my parents that are like, I don't know necessarily what this means. So their perception of this technology is a lot different from myself.
Absolutely.
And ideally, I see it as a bullish thing. They see it as a bearish thing. And I'm like, hey, this is ideally, if we look at how the markets are reacting to it, it's making people more productive. And we have seen a run up in positions that are levered on AI technology.
Yeah.
And to me, I look at other money managers that aren't necessarily considering this, and I'm like, you are missing an opportunity for your clients to really establish a portfolio that is hedged against the risk of not being in a productive cycle with AI technology.
Sure.
So, yeah.
So that being said, I mean, that before we get into our topics, how are you seeing AI affect you guys' industry? Because in our side of the tracks, we're seeing AI helping us bridge gaps between things that typically would take us a while to do, done like that. And we're talking super simple things from I need a script to put onto social media to I need you to calculate the property taxes if the tax rate is this, the homestead exemption is this, et cetera, et cetera.
Right. So in terms of markets and how it's affecting, companies that we buy,
Sure.
I'm looking across every industry that you could possibly think of, because what AI is actually doing is it's making everyone more productive. And then 2, ideally, companies are reducing cost.
Yeah.
So when people get more productive, companies reduce costs. Bottom line for that is net income goes up.
That's right.
So ideally, it's an opportunity as an analyst from the analyst perspective. We look at it as, hey, this is good for companies. We need to pinpoint which companies are actually levering this technology. 2, my industry specifically, when I'm looking at reports, the way that I use AI technology is you have your annual reports, you have your quarterly reports from companies, right? And ideally, this is 200 to 300 to 400 page documents that you're looking at on an annual basis, whether it's a company you're invested in or a company that you're looking at.
Yeah.
What AI allows us to do, specifically like ChatGPT, if you have the paid model, ChatGPT allows you to upload a 300 page document and ask ChatGPT, give me the points of where this document is talking about, let's say, for example, decentralized finance.
Yes.
Or where this document is talking about how annual numbers have suffered for the past 2 years. And that allows you to build a baseline to analyze the companies faster.
Absolutely.
Right? I'm no longer having to sit down on a Sunday reading a 300-page document times 36 positions that we're buying.
Yeah.
So now I'm able to do that in a much quicker manner.
Way more efficient as well. Yeah. No, I mean, I discovered that. I mean, I'm one of the early adopters of ChatGPT, the paid version.
Yeah.
We've been using it now since launch. And we'll throw PDFs of guidelines that are thousands of pages. Say, hey, instead of me going through and hitting Control F to try and determine where
Right.
that is, and then now let me try and interpret, it's more so let me just ask it the question with the scenario, utilizing this guideline, this PDF guideline. Give me your opinion, and give me the sources in which you found it so that I can go back to those pages to make my own conclusion to whether or not we can do this scenario.
Right.
Super, super fast.
Yeah, and that's the important piece of it, right? Everyone thinks that, oh, let's just plug it into ChatGPT and then it's going to give us all the answers. Ideally, no. The human factor is very important, especially as fiduciaries. Like if we're managing money, we're doing things for our clients and we have to do it in the right way. We can't say we're a fiduciary if we're not in tune with what's actually happening.
That's right.
So ideally, yes. Does it help us read these reports quicker? Does it help us make better decisions? Yes. But absolutely, does the factor of I'm having to contemplate. After I read a report, there's a lot of contemplation that happens internally.
Correct.
In terms of making a position, either selling out of a position, buying more, putting a new position into a strategy. So there's a human factor to AI technology that a lot of people tend to discount.
Yeah.
It's not necessarily the pill that's going to solve everything, but it is going to make us more productive. It's going to make us work quicker.
And a lot of folks would, when it was coming out, saying it's going to replace humans. I was the one saying it's not going to replace humans, but it will leave you behind if you don't utilize it.
100%.
Yeah, I mean, it's not going to replace you by all means, but if you're not leveraging it, using it, incorporating it into your day-to-day, if you're in business, matter of fact, in any business, there's a way to utilize it to make your life streamlined, et cetera. You're just going to be left behind.
Yeah.
And it's up to you to try and catch up to that, but it won't replace you, so to speak, because you're still human. You're still thinking.
Right.
You just don't have all the answers, essentially, at your fingertips.
It's true.
So, do I ask this question now? I'll hold on to this one. Do you know anything about BRICS?
Are you talking about
The additional currency that basically is about to devalue
Saudi
our
Arabia,
dollar? Yep.
Russia?
Yep.
I forgot who else. China.
Yeah.
I know a little bit. But yeah, I mean,
We'll come back to that.
Yeah.
We'll come back to that one. So the next thing that we want to discuss here, and I thought it was an amazing topic here, it says many overlook the idea of investing. And you know that you did, right?
Yep,
when you
I
were
did.
younger, I mean, even as we got a little bit older, the concept of it. But the power behind it and the compounding, can you explain that to us?
Yeah. So ideally, when you think of investing, you know, there's risk. There's always risk that is involved, whether it's risk within what asset allocation you're putting in, what companies you're buying. Companies could go bankrupt.
Yeah.
Industries could go bust for a period of time, right? If an administration comes in, there's different risk factors that exist within a portfolio.
Right.
And when you compile a portfolio, when you build a portfolio of assets, there are measures of risk that you should probably be in tune with. How investing and compounding works is ideally you have a timeline, right? So if I'm 75 years old and I know that I can't afford a down period, could you imagine if you're 75 years old and you had a 2008 and you were invested in all stocks? Your portfolio would take a hit. Your life expectancy in the United States is probably like, I mean, for me, it's
83 or something like that.
For my family, it's probably like 70. but so there's a position there, right? In 2008, it hit, and if people were over allocated into stocks and they were at a higher age bracket, then they didn't have that buffer to make up, right? And we saw, I think it was like a J curve up after I think a year.
Oh yeah.
So ideally, when you think of investing, you have a timeline.
Right.
You're 75, you have a shorter timeline than the 20-year-old. And this is where I missed out, right? As a 20-year-old, those perspectives really didn't come into play. It wasn't until later where I was like, man, if I invested when I was 20, by the time I was 30, and if I invested, let's say, $10,000 a year, you would ideally have a really nice nest egg after 10 years because I think it's like a 10 to 12% S&P return.
Right.
And then you compound that over a span of time. I don't have a calculator with me, but ideally that's huge.
Absolutely.
So there's a benefit that the younger that you get started investing,
Right.
then ideally you are able to build a bigger nest egg with reduced risk.
And even that concept that you're talking about here,
Yeah.
it even applies if you don't have a ton to invest.
Right.
And I
Right.
think that's what a lot of folks tend to miss or to overlook is, I don't have enough money to become an investor. Guys, what extra do you have, number one? And if you don't have extra, it's time to look at what you're doing every month, every day to determine what excess are you spending on that could be utilized to leverage, to compound for
Right.
your future.
Yeah, this is true. I mean, even if it's $1,000 a year, $1,000 a year over a span of 10 years, compounded at 10 to 12% every year
Every
that you're
year.
making on that is
Yeah.
huge.
Absolutely.
It's huge. I don't want to bore people with the actual calculation
Right.
of that, but I mean, they could do that at home, and you would ideally
You'd be
see how-
surprised. Well, I mean, this is kind of what I would imagine you are doing a lot of today. And JC, if you can throw that reference up here. So tell me about Portafolio.
Yeah. So we have an investment philosophy, and you could click on this if the viewers are watching this, but we have an investment philosophy that domestic markets, basically markets within the United States, are superior.
Okay.
That's one kind of factor into it. Two, equities markets are superior than to any other market.
Okay.
So when you think of a bond portfolio, when you think of a portfolio, back in the day when you and I were young, the status quo of a bond allocation was always like the 60-40.
Yeah.
You had a 60% equity position, 40% bonds, so that way you're kind of hedging that risk.
Correct.
Our investment philosophy is completely different than that, and we could read the top 5 principles that kind of guide us, right? So we believe domestic markets, equities markets, are superior to any other segments of the United States economy in terms of liquidity and long-term wealth generation. Diversification, of course, allows us to minimize unsystematic risk inherent in the equities markets. Specific sectors of the market behave differently in times of expansion and contraction. A well-positioned portfolio maintains a long-term outlook and keeps an open policy to shift in and out of positions within the sectors of the economy. And then the last one is, of course, I don't know if you've heard the term, don't fight the Fed.
Yeah.
But basically, Federal Reserve monetary policy affects investment securities and should be acknowledged.
Absolutely.
So that's kind of a huge factor in how we position portfolios. But these 5 principles are kind of the tenets that guide us on how we invest into markets.
And I am actually super thrilled that your last one, which I believe is one of the most important ones that many don't even consider. They want to give their 2 cents about it, but then they don't take any actions based on what just took place.
Right.
The Fed. We know that during the pandemic, the Fed dropped their rates to 0, so there was free money, so to speak.
Yep.
How many people took advantage of that? Probably not too many. Yeah.
Not many. Either because they were being ignorant or just didn't know.
I think maybe both.
Maybe both.
Maybe both.
Yeah.
Simply because, well, you also have those that maybe knew or could see and were scared. Fear tends to get us to not do anything. But I can tell you that the Federal Reserve and their monetary policies and what they drop and raise do affect the mortgage and real estate markets.
100%.
If you don't mind, could you tell us kind of how that works?
Yeah. So basically, we have what's called, I'm not going to say quarterly because it happens more frequently than not, but basically the Federal Reserve publishes a calendar. Mm-hmm. In that calendar, they meet for 2 days, and then one of the last day that they meet, the Federal Reserve chairman comes out, speaks, and says, hey, our FOMC, which is a committee of all the regional banks throughout the United States, mm-hmm. they implement a policy of either holding rates, raising rates, reducing rates based on economic data that's coming out. Typically, it's jobs, unemployment rate, inflation numbers, inflationary data. So there's a list of a lot of data, and we publish a lot of that on our website.
Okay.
But there's a list of a lot of data that the FOMC looks at whenever they establish monetary policy.
Yeah.
But everything, in short, Fed funds, everything is kind of pegged in the United States. Everything is kind of pegged on Fed funds.
Yeah.
Right. The lower that Fed funds is, mm-hmm. the more liquidity is within certain aspects of certain sectors or certain places in the economy.
Yeah.
And that allows people. So you tend to see when rates are low, people are buying more stocks. There's a wealth effect to that. When rates are high, stock markets are a little more depressed. And that ideally, I mean, when you think about it, what is the true essence of what's happening there? Rates are high. It's harder for companies to use whatever capital or borrow capital to infuse back into their business.
Correct.
So that slows companies down. This is why during an inflationary period, the Federal Reserve raised rates, right? Because they're trying to cool the economy.
Correct. And that's actually what is still happening to this day. And a lot of folks, I get this question 10 times a day, is when are rates going to come down? And my explanation, and you can tell me if this is accurate or if it needs a little fine tuning, is guys, if they were to drop rates down tomorrow tremendously, we would have a bigger issue on our hands. And the reason why I say that is if I look at real estate, if rates currently sitting, let's call it 7% right now, prime rate, if they drop down to 5% tomorrow, meaning the Fed cut a whole point, then everybody went, woo, all right.
Right.
What it's going to do is basically induce all the folks that are sitting on the fence waiting to buy, we're waiting for rates to drop. They're going to jump in the market. What does that do to the price of real estate? Everything shoots up through the roof. So it then would trigger even more of an inflationary period for us.
Yeah, you're not entirely wrong on that.
Okay.
So ideally, housing is an aspect of the inflationary data that they're looking at, right? They want to slow down markets. Housing is one of them. They want to make housing a little bit cheaper because it's crazy right now, right? Or whatever it is. So yes, you are correct. Housing is a component of what they're establishing, setting policy to.
Okay. What additionally could I, moving forward, add to that would make it even more valid? Because I don't want to pretend that I'm something that I'm not.
Yeah.
I'd rather just say, hey, you know what? Just call Mauricio. Miles got you.
Look, I think you're 100% correct on it. I think you can add that not only does it affect housing, but here's the scary part. If the Fed has established an interest rate reduction policy now going out of, I think it was 2 meetings ago.
Right.
Last week, they dropped a quarter of a point. We're at 4.5 to 4.75 range right now. Before that, another 50 basis points.
Correct.
So we are in a position of where they're looking at it from what's called like a dovish perspective. They're trying to drop it, but they don't want to. What happens is, like you said, if they tend to drop too hard, then, and the issue of inflation uprising again, that is a factor when you think about. There's like an untold. I'm trying to make this easier to understand to someone that's not finance oriented. Basically, when the Fed speaks, I'll just give you an example, and this might make sense. Alan Greenspan, back in, I think it was 2001.
Yeah.
2001.
2001-ish.
Right. Somewhere around there. Alan Greenspan, there's an unspoken nature to what, and Alan Greenspan, for those who don't know who it is, it's the chairman of the Federal Reserve back then.
Yeah.
If we
was
could
replaced by Jerome Powell, you guys.
Right. Well, actually, it was Bernanke, Yellen, and then Jerome Powell now. But basically, there's an unspoken nature to how people view the chairman of the Fed, right? And it doesn't necessarily always have to be about what they say or what they establish in policy, but maybe about what they're doing. Back then, they would look at Alan Greenspan walking into the Federal Reserve Bank right before an FOMC meeting, and they said, if his pamphlet is, if his notebook is fat, then he's getting in there ready to try to convince his Federal Reserve regional bank members that inflationary pressures are high and they probably need to reduce rates. Now, this is something that the market just began to formulate about Alan Greenspan.
Okay.
This wasn't like set in nature, right? It's just the markets make their own understanding about what's happening.
Sure.
And then the markets react. This is why you hear the term, the market is pricing in a lower 30-year yield on the federal treasury.
That's exactly correct. And kind of to help in that regard, on the mortgage side of things, guys, when we see Jerome Powell walk out and give his announcement, we as mortgage bankers have already priced in what we anticipate him to do. So it's not like, oh, Jerome Powell just lowered rates a quarter. Guess what? We already anticipated that, and we did it before him. And it's not necessarily a quarter for quarter either. Just want everybody to know that.
Yeah, and I mean, even when you look at it, interest rates have been reducing, and I think they're still at the 6.8, 7 that we were at.
6.8 to 7.13. They've just been teeter-tottering.
Right, and that's before they started implementing a policy. So, in essence, yes, you're like going back to your question is you're 100% correct, but there is a lot of more information or data that sits on the back end that we can look at and basically say that if any of those pressures react negatively to what the Federal Reserve is doing, what the FOMC is doing, then we have a bigger issue.
All bets are off.
Right. All bets are off. The markets are making their own presumption or assumption about where markets are going, and then the Fed loses faith, or the market loses faith in that the Fed can establish a baseline, and then we have bigger issues.
Yeah, for
right.
sure.
The moment that the markets begin to say, "Hey, the Federal Reserve is out of whack," like they don't know what the fuck they're doing.
Right.
That is a moment that we should be worried about what's happening.
Yeah.
When markets begin to price something like that in.
And that's kind of what, I'm not going to say it scares me, but it's something that is concerning about this BRICS thing that's happening. You're seeing the 10-year bond go up, meaning we need more people. We need it to be more attractive for people to invest into our 10-year bonds. And typically it's outside markets that invest in those for the most part, but it's not necessarily affecting mortgage rates, which is totally contradictory to what we normally are used to. And it's like, okay, is our value becoming weaker?
Ideally, I mean, think about what we've been doing fiscally, right? So we have two policies that happen in the United States. We have monetary policy, which is established by the Federal Reserve, and then we have fiscal policy that is established by an administration or the legislative branch, the Senate, passing laws to stimulate the economy.
Yeah,
two very
unelected.
Different, right? two very different things. But ideally, what we've seen is whenever you see, for example, in 2008, fiscal stimulus checks went out. Whenever was it Obama or George Bush?
It was that had to have been Bush, wasn't it?
I think it was,
what year? Yeah,
I think it was Bush.
Let's see.
It was right before Obama.
That was
went
one of
in,
the first ones that we.
What year was it?
2000. Let's say 2008. Right when the
2008. Who was the president? I think that was. Let's find out. Boom. George W.
There you
George
go.
W.
When did
Bush.
Obama come in?
Obama
Inaugurated the winning 2008 election. Okay.
There you go.
So whenever the economy was being hit by the crash in 2008, fiscal stimulus checks were written and sent out.
That's right.
Why? Because they were trying to stimulate the economy because it was getting depressed.
Yeah.
Right. The economy was going into a depression, and they were like, we need to do something to fix this issue before we have breadlines.
Right.
That in addition to bailing out the banks. And that's a whole nother story in itself. But that happened.
Yeah.
That's what's called fiscal stimulus.
Okay.
Fiscal policy that is induced into the economy. Right now, where the economy's been doing great. We've had a 16-year bull run in markets, meaning that companies have been doing well, making earnings. You know, the stock market is great.
Right.
And we still had fiscal policy that has been putting money into the pockets of the citizens.
Yeah.
When you write, you have to understand, when you write fiscal policy into play, it's not like nobody's paying for that. Our debt goes up as a nation.
Absolutely.
Right? So U.S. debt goes up during the cycle of that.
Matter of fact, we had 2 episodes back to back just discussing. We had the national debt calculator up on the screen, and we just dissected the shit out of it. It was like mind blowing to see how all of these figures stack up and are relatable to what we do every day. And we go, whoa, let's put this in perspective for you. It's just nuts to kind of bite off that, you know how they say, how do you eat an elephant one bite at a time?
This is
That's
true.
a big ass elephant.
It is, man. It is. And I'm trying not to go too finance on it because I know you have people
I don't mind.
So ideally when the debt is going up, ideally you have other nations, and this is why what it goes back to the 10-year bond. Whenever you have auction, people are still buying it, but people are beginning to look at other outlets, such as what you're speaking of, the BRICS. They're speaking of other outlets in terms of what can we begin to look at outside of the US dollar that is really the strength of something we want to be either pegged against or something we want to rely on.
Right.
When they see the debt goes up, that is worrisome. Maybe not in the short term, but in the long run, our generation specifically will definitely pay for the price of that.
Yeah.
Your kids will pay for the price of that. My nephew will pay for the price of that. And then their generations going forward, unless we begin to ease off of the fiscal stimulus factor in terms of what these administrations have been doing.
Correct.
But yeah, scary spot.
No, it really is. I mean, I've got a couple more things that we can dig into here. And one is this one's kind of opinionated, and there's no wrong or right answer unless there's data to back it up. Because we hear oftentimes that, and this may or may not even be your sector, but I want to put it out into the ether. We hear a lot of times on the news, on the media, that such and such is giving tax cuts to the wealthy. And all the research and data that I find, that tends to actually benefit the layman, the middle class, et cetera, due to the trickle down effect, so to speak. Why? Business owner. Let's say I'm a business owner. I am. If I'm getting tax breaks, meaning I have more on my bottom line, I didn't get here by taking the money and pocketing it. I got here by reinvesting and believing in myself and continuing to bet on myself and my employees. So what does that mean? I'm going to give raises to people. We can incorporate more technology. We can incorporate some things that we couldn't before, didn't have the funds to. That's my theory on it. But I want to get your take on that because you've got more of the financial side to kind of back it on.
Yeah, I do. If you look at it, is there a trickle-down effect to an easier policy on corporations? I would say yes. However, there's a number of other things that you have to look at in terms of, hey, are the normal citizens that maybe aren't necessarily entrepreneurs or business individuals that are owners of businesses benefiting from it? There's a lot of other factors that you would have to look at to make that decisive decision, right?
Sure.
But do I think that there is a bullish signal, meaning that is it good for markets? Is it good for companies? Is it good for entrepreneurship? Is it good for businesses who are hiring people whenever you have policies that are either hands-off or easier in terms of being taxed too hard? I do think there's a benefit in that because we look at the end of the day, we're looking at our P&L. Yeah, that's right. And we're trying to figure out where can we profit from, where can we cut losses? And this comes down to the productivity thing. This comes down to all the factors that establish our bottom line in terms of a business, right? Net income is at the bottom.
That's right.
What can we reduce in terms of cost of goods, in terms of overhead, in terms of, am I going to hire the person who's actually educated in real estate opposed to hiring someone that's just coming into the industry that had left another industry and doesn't know what we've dealt with for the past 10 years.
That's right.
You look at all those things, and those are the factors that I'm speaking of. But yeah, hands-off policy or easier tax incentives for a business. Does it help an economy? I wouldn't combat that at all. But there are a lot of factors that exist.
No, I think that's pretty dead on and accurate because most business owners, and I don't know why we do this, but in times of crunch, we do tend to look at where we can cut to save instead of looking at how do we make more revenue to combat that.
Right.
Which is odd.
Yeah, I mean, we look at both ways, right? I mean, people that own businesses, we do look at, okay, what can we create a bigger income stream by doing what, right? Like we look at it, but what does it take for you to look at? It takes time. It takes time where you're taking out of running your business to actually begin to strategize.
To work on your business.
Right. So the easiest thing to do is to cut cost.
That's right.
And then when you're slow and you're like, okay, you have time, Now you have an opportunity to strategize and build bigger income streams.
That was a fantastic observation, and I didn't even put that together, but I think you're right. As a business owner, you are correct. We are constantly caught up in the day-to-day of doing business that it does take time to work on the business. So you might as well just do what's easiest and quickest,
Right.
cut some cost.
Yeah. I mean, this is the same policy that I look at whenever we're buying companies, right? Whenever you buy a company, and you'll see, like, for instance, like the corporate raiders like Carl Icahn, Bill Ackman, whenever they buy a position into a company and they revamp the board and they hire a new CEO, why are they doing that? You got to think of it, right? There is a strategy factor. There is a mindset factor that these companies, whatever they've been doing for a certain amount of time, probably hasn't worked for a reason.
Right.
And there's no way to change the mold of how somebody has been running a company other than to get rid of them.
Right. That's right.
So we see that a lot. So when you hear company news, typically if a company has been depressed for, like, let's say a cycle of like four quarters, and you're like, well, what's going on? And then suddenly you hear news comes out on CNBC and they're like, hey, the CEO just got ousted, and you see the stock just jump.
Disney,
Right.
for example.
Right. So you see those things happening, and that allows a company to do better. And then us as investors, when we buy into an opportunity like that, it gives us the opportunity to grow with that change.
And that right there almost reminds me of was it The Big Short? No, it wasn't The Big Short. It was oh gosh, what is the other one? Wolf of Wall Street.
Wolf of Wall Street,
where Matthew McConaughey says it's a fugazi.
It's a woozy.
It's a woozy. It's a woozy. Why? It's
I love that movie.
basically propped up on what people believe to be true, so much so that they're willing to bet their dollar on
Right.
it to a certain extent.
Yeah. I mean, like when you think of companies, right? Like companies could be doing great.
I mean,
And the
look
market
at
could
let's
still
talk
punch
about
them.
Warren Buffett. Recently, Warren Buffett pulled all his money out of the sucker. And everybody's going, what the heck's going on?
What do you
What's
sell? A
going
lot of it was like Amazon recently.
He sold out of I think, let me see if we can find that. Recently.
This happened like this week or last week, wasn't it?
It was maybe a week ago. Recently, Warren Buffett liquidated his stake in many companies. How much was it, and did it move the market? And that's kind of what I'm getting to, is how can somebody have so much of a position in and an influence on the markets that it moves the whole markets when they do something. It's like, oh, he's breathing again, or he sneezed. What are we going to do now?
Yeah, I mean, when you think of it, I think the SEC makes everyone that's a 5% owner or above, you have to file that you are a majority owner when you just own 5%.
That's crazy.
That's crazy, right?
Yeah. So this says, and it gives us two answers because it always likes to know which one we prefer. But it says Warren Buffett, Berkshire Hathaway has significantly reduced its holdings in several companies over the past year. Notably, the firm sold approximately $127 billion worth of stock in 2024, and that was super recently,
right?
Including a substantial reduction in Apple's stake by nearly 2/3. Bringing it down $69.9 billion. Additionally, Berkshire sold $34.6 billion worth of stock in the third quarter, notably including significant sales of Bank of America shares. So, I mean, that kind of stuff that happens.
Right. I'm seeing how much he sold in Amazon. This happened. I'm surprised they didn't tell us what happened last week.
How much did Warren Buffett recently sell of Amazon stock? Boom. Let's see. This thing's pretty smart. There it is. Boo, 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 boo. 2023. holdings by an additional, okay, let's see here. The firm reduced its holdings by an additional 551,000 shares, a 5.2 decrease. So
That'll move a market.
that'll move a market.
Yeah.
You know?
5.2 decrease. I don't know what the position was before, but yeah.
That's going to move some stuff.
Right.
And people are going to go, well, what's going on?
Right. Right.
Yeah, there's this stuff fascinates the hell out of me because we can't see it, we can't touch it, but technically you can if you do the research.
Yeah.
Does that sound about right?
Yeah. You're saying you can't touch what company specifically?
I mean, you can't necessarily touch the bandwagon that you're jumping on. It's like the concept of the dream. Can you touch the dream? No, you can't. But you believe it to be true, so therefore you're going to act upon it. You can't actually, matter of fact, you don't actually make money until you cash it out.
Right.
Right. So it's like, yeah, I've made so much money in the stock. Okay. And tomorrow it falls out of the bottom and that's gone. So did you really make money or you're just seeing these numbers on a screen moving?
Right. Yeah. I mean, and that's the important piece of like diversification. I know a lot of people, specifically younger generations right now, are big on the day trading thing.
Yeah.
And it comes down to me, day trading, because I used to do it a lot.
Yeah.
I learned that is a zero-sum game. You're going to have good days, you're going to have bad days, but if you look at it, whether you're a year out, whether you're 2 years out, you're probably going to be at zero or you're probably going to be at negative.
Yeah, what does they call it? You're better off doing that cost basis, like every week putting X amount.
What is it? Average cost?
There you go.
Average cost purchasing,
There
dollar
you
cost
go.
averaging.
There you go.
But yeah, ideally, that's the important factor of diversification, buying into, not just one or two or three or different positions that you like, but buying into at least, let's say, 15 to 20 positions that you like, having a portfolio allocated, and then sitting back. And if you believe in those companies, then you should ideally have no problem with the tops and the bottoms of that stock moving up over a span of a couple of years.
Peaks and valleys.
Yeah.
Peaks and valleys. So, JC, what time are we at?
56 minutes on
I
the dot.
love it.
Nice.
Gives us time for our last topic because you mentioned the younger generation doing day trading and things of that nature. And I'd like to know your thoughts on, because obviously you're big on finance. You're big on financial literacy. You're big on financial education.
Yeah.
I myself am, as much as I possibly can be, from a mortgage real estate perspective. You get to see a different world than I do. But I believe that this day and age, our younger generation, because we have so quick access to data, we have a lack of attention span. I mean, it's like the max is 8 seconds these days. You've got teachers that are overwhelmingly underpaid, in addition to maybe overworked, maybe not overworked. But I don't believe we are setting up our younger generation for success.
Yeah, I would agree with you on that.
Tell me your thoughts on that.
I think, for one, I think it comes down to parents also. Parents have to, and I'm not a parent yet, but just seeing across the board, because I love to mentor younger minds.
Sure.
And I like to get into their heads to see what are they experiencing that either gives them hope or dwindles hope.
Well, hey, that's our future.
Right,
You
right.
know?
So I spend a lot of time, talking to kids, talking to younger generations, whether they're in high school or college, but really trying to understand, okay, where are you guys positioned in terms of mindset? For one, I think it comes down to parents. I think parents have to set the precedent that the world isn't easy. And if your kid is graduating high school and is going into the real world thinking that life is how it was whenever they're living under your household, then they're going to walk into a rude awakening. So one, I think parents have to do a better job of setting the expectation for kids or younger minds to walk into that field, because it's a scary place to be, regardless whether you've been molded or not. But could you imagine not having the correct understanding of what you're walking into?
Right. And just to break this conversation up briefly, I want to just ask this thing one more thing that may put this into more of a perspective of what we're discussing.
Yeah.
What percentage of Americans invest in the stock market? I think we're going to be thoroughly surprised. Okay. Approximately 62% of the U.S. adults. Oh, wow. It's breaking it down.
Let's look at the lower income. There you go.
That's what I was trying to get to. Yeah, that's right. 25% only in the lower income. Now, what do they consider lower income? I'll just ask it. What do you consider lower income households? Let's see. Lower 52,000. Okay, so that's most of Americans.
Yeah.
And only so here it even breaks it down by demographics.
Right.
We're going to only focus on that lower income, which that for San Antonio is average income, to be honest.
Yeah.
Only 25% of folks actually invest in the stock market. And I would go as far as to say that most, if not all, are simply doing it with their 401k and not actually individually picking stocks, managing their portfolio, or have a manager of their portfolio.
Right.
And this says in the lower stock ownership by race, believe it or not, more black people own stocks than Hispanics.
Yeah, I believe that.
Let's see here. No college education. 33% of non-college educated people own stock.
In comparison to what some college, 56. That's a big variance right there.
Absolutely. Post-grad, so it's like something about the college that gets you to see the light and go, maybe I should start investing.
And I think it's because I think high schools and maybe generations or schools before then, middle school, we'll say middle school also, I think they fail to teach how necessarily the economy is actually working.
Great. Can you elaborate?
Right. So when you go in, and I have a nephew and he's taking a finance something, but he's like, it's an electrode, I might drop it. And I'm like, you're absolutely not going to drop it. I'm like, why would you do that?
Are.
Right.
Yeah.
I'm like, you're telling me this? I was like, no, you're not dropping it, man. So when you think of what they're teaching in schools, and I would have to look at the curriculum of every different district. He's in Northside, but I would have to look at the curriculum and say, okay, but from what I've positioned and from what I've seen is that schools are not necessarily teaching these younger minds how the economy works, not even just finance.
Right.
Basic knowledge of how the economy works, right? What makes the economy run the way that it does?
Right.
Why are companies in the business of making a profit?
Mm-hmm.
What do they do? What good do they do for the world?
Yeah.
And I think that kids are failing to understand that in the most basic form.
Yeah.
Right? They think that, just because a company is running that, they're going to provide a job. And it's like, no, in certain periods, they're not hiring.
Right.
And why aren't they hiring? Well, they're not hiring because there's no money in their balance sheet, or there's no money that is in foresight of their pipeline.
That's right.
And so
they're on the verge of insolvency, but they're still running.
Right. And then you have a kid that's hoping, he's getting out of high school and he sees his company that he wants to work for just go under. And then he's like, okay, now I'm lost. Right. All of those perceptions could be eased into the reality of how our world works if schools would just teach how the economy truly functions.
And a lot of folks would say, well, they're too young to even understand that stuff.
Bullshit.
I say make it fun.
Make it fun.
I was
agree.
having a conversation, and this was several months back, with another loan officer in Idaho Falls. Shout out Deborah Criddle. She had a genius idea. She said, why don't, in elementary, we start off with having the kids come in and they pick from a hat or something with a bunch of different professions. Mm-hmm. Boom, you pick it out, and fireman. Okay, great. So for this month or this year, this quarter, whatever the time period is, you're going to get a paycheck based on that career field. Mm-hmm. And you've got to have a budget, and you're going to pay rent, or you're going to pay mortgage, and you're going to pay auto and your light bill, et cetera, et cetera. And it doesn't have to be that elaborate, but just getting them to understand the concept of money management and seeing, oh, wow, this is how my parents allow me to go to school, the clothes that I wear, the food that I buy, that kind of stuff. And that kind of makes it fun and also enlightening for the kid, because by the end of the semester, what have you, and they go, man, I'm out of money. Chances are I don't need to be a fireman or a teacher or a this or that. I need to go and take some risks into this other profession. Then you've obviously got professions that are commission only, entrepreneurs, things of that nature. But what I do think is a practice like that would get the young minds to start thinking the way that would lead them to open the doors, or at least be intrigued by, what does that mean? What does, if I do this, what are the repercussions of it?
Yep.
That then kind of opens the door or leads it into them asking their parents more questions.
Yep.
Because what I've found is, more times than not, parents want to shield their kids from any type of downfalls that are taking place within the family. So they shield them from it. Then when that kid grows up and has their first windfall, they don't know what the hell to do.
Right.
And they think it's the end of the world. Kind of like what we're seeing right now, where participation medals seem to be the buffer for getting a good solid ass whooping.
Yep.
Type concept.
Yep.
I don't know. I firmly believe that there needs to be something implemented within younger generations, elementary, middle school, that I know that I didn't receive.
Yeah,
I received it from my parents straight up. They were very transparent. I'm appreciative of it. At the time, I'm like, God, man, why do I need to learn this stuff?
Right.
But fast forward, many other peers had no freaking clue what I'm talking about.
Right.
You know?
Yeah, and the reality is that some families have it harder than others, and there's no doubt about that.
Mm-hmm.
But it's to me at least, it's very important to, and you could start lower doses, like you said, lower doses in elementary school. By middle school, kids are already feeling the pressure if they have siblings, and it's harder for mom and dad to pay for one soccer league, and other Johnny's soccer league isn't available because there's no money in the bank right now. You know, kids begin to feel the pressures of that in middle school. And so it's important to talk about the economic factors, in my opinion, of why is it harder for you? Why can you play soccer this season and your brother can't?
Yeah.
Or why can your brother not play this season and you can? Right? And then you form a gratitude for that, and you form more discipline in terms of, hey, there's an opportunity that I have on the table right now, and this is I can't take this for granted.
That's right.
Right? So like there's a lot of benefits to smaller doses, and as you get older, speaking of the realities of what's happening, and by the time you're in high school, hey, it's full-blown picture, right?
That's right.
Like for instance, we graduated 2007, or I graduated 2007. From high school right before the crash. And then the crash happened. Luckily, I was going into the field of finance where I learned a lot of those things, but I couldn't imagine not studying finance during that time. Where I'm just watching like markets are going haywire. They're speaking about we're about to have bread lines if Timothy Geithner. Yeah, dude. Like, I mean, all these things start happening. Like, man, I'm lucky that I was in finance classes during those periods, because if not, I would have been like, stressing out.
That's right.
Because I wasn't prepared for that during high school.
And they say that anxiety is an all-time high and depression's at an all-time high. It's like, well, I can see why. We're shielding the next generation from real life.
Yeah.
That's just, I don't know. We can go on and on about these topics.
We sure can.
But Mauricio, I think this was a great discussion. I think the folks listening got a ton out of it. I know I did.
Good, man.
I want to thank you for enlightening me and educating me on all the things that you did within this hour period. Is there anything that you would like to close us off with?
No, just thanks for having me on, Mark. I appreciate it. It's always good catching up. If anybody has any questions, they could find my contact on my website, portfoliocapital.com.
And tell us exactly what you do real quick as we close this out.
Yeah. Basically a position. If you have
Talk right there.
If you have long-term capital, anything that's exceeding 3 years, when you think about money, anything that's exceeding 3 years should not be sitting in a bank account, because you have inflationary pressure that lowers the value of the dollar. And so ideally it should be diversified within an asset class, whether that's stocks, bonds. Depending on your age, depending on your risk factors, you invest that money, and then you watch that money as you get older. Basically, my firm is in charge of managing that capital. So we're a long-term capital manager. We're lawfully abided to act in a fiduciary capacity. So know that if you're investing money with us, we're doing what is in your best interest before anything. We're not here to sell you anything. We're not here to put you in an insurance program. We're basically diversifying whatever investments you have to make sure that you are aligned with your risk tolerance and for the betterment of your future. And it's not our future. It's not anyone else's other than the clients. And that's basically what we do for our clients.
That's badass. Ladies and gentlemen out there listening, if you made it this far in the discussion, I'm hoping that you gained all the knowledge and education in this short period of time that I just did. If anything, it gives you a little bit more to think about and to consider when you get your paycheck. You as a realtor, you as a lender, we know that if you don't wake up tomorrow starting to sell real estate, there's no residual in our line of work. So you've got to continue to put money in places that will breed and fruits down the road. And that is a great way to put it. Real estate is another compounding investment. Why? Because there are year over year equity growths. Typically, San Antonio is about 5 to 6% in the last several years. It's been way higher, but definitely something I don't necessarily look at real estate as an investment. I look at it as honestly one of the biggest investments. Why? Because you got to live somewhere, guys, and it's pretty cool to be able to take and tap into that home that you just paid into to go and complete your dreams, to pay for college, to help your family, to get to the next level of whatever it is that you're trying to accomplish in this life. I want to thank you again for joining me.
Likewise, Mike. Mark,
and like I said, guys, we will only bring experts to you. We will continue to bring experts to you in the field in which we're kind of going through at the moment. Hope you guys are getting something out of this. Make sure to like, subscribe, share with a friend. You never know who could need some of this info. But until the next one, we will catch you later.
And we out.
Damn.
Nice, dude.